Welcome in, everyone. Today, we're going to be unpacking a high-stakes financial mystery, one that most of us honestly don't fully understand until we're literally sweating across from a loan officer. We are talking about the true financial weight of credit scores. Okay, let's dive into this with a super common scenario. Picture two people. Let's call them Buyer A and Buyer B. They walk into the exact same dealership on the exact same day. They have identical tastes, so they pick out the exact same car. On top of that, they both have perfectly stable jobs with steady income, right? On paper, they look like identical customers. And yet, Buyer A drives off paying the standard loan cost, while Buyer B ends up paying thousands of dollars more over the life of that exact same loan. Thousands.
So why? How does that even happen? How can two identically employed people buying the exact same product experience such completely different financial realities? Well, the answer isn't about their negotiation skills and is definitely not some hidden fee. That massive price discrepancy is caused by a simple three-digit number, a number that follows you absolutely everywhere.
Section 1. What is a credit score? The basics. So, fundamentally, a credit score is just a tool for risk assessment. That's really it. It's a number that helps lenders estimate how likely someone is to repay borrowed money on time. It is strictly about repayment probability. It doesn't define your character, and it definitely doesn't measure your intelligence. But despite being so narrow in its actual definition, this one number is an absolutely crucial factor that many lenders lean on incredibly heavily when making their decisions. Now, what's really interesting about this slide is that this three-digit number isn't just pulled out of thin air. It's built on four interconnected pillars. Basically, you've got 25% based on paying your bills on time. Another 25% is keeping your balances low relative to your limits. And the rest is split between maintaining a longer credit history, proving you're reliable over time, and avoiding excessive new applications, which can actually signal financial distress to a lender. All these pieces feed directly into the algorithm.
Section 2. The cost of low scores and the overall financial impact.
Think of a high credit score as a literal VIP pass in the financial world. It automatically helps you qualify for loans with much lower interest rates. A lower score, on the other hand, acts like a barrier. It triggers higher borrowing costs and way stricter approval requirements. You're basically paying a premium just to access the exact same money as someone with a better history. It's wild when you think about it. $300,000. To really put this into perspective, imagine borrowing that much for a home mortgage. At this massive scale, a seemingly tiny difference in the interest rate, like literally just a single percentage point on a 30-year mortgage, can snowball into tens of thousands of dollars in extra interest. That is a new car's worth of money straight out of your pocket, all because of a three-digit assessment. And the crazy thing is, it's pretty much inescapable. Remember our two car buyers? This same score ripples out to affect their home mortgages, personal loans, and even rental applications, where landlords check your history to guess if you'll be a reliable tenant. While the exact requirements do vary based on local regulations, the overarching theme is always the same. Your financial footprint is constantly being evaluated.
Section 3. Improving your credit score with actionable steps.
Let's move to and see how this builds into a straightforward playbook for improvement. Step 1. Consistently make your payments on time. Step 2. Actively reduce those outstanding balances to free up your limits. Step 3. Relentlessly avoid missed payments. Seriously, they leave a lasting scar on your record. And Step 4. Simply demonstrate reliable behavior over time. There are no overnight hacks here, guys. It's all about playing the long game. Section 4. The bottom line and our core takeaway. So, the crucial point is recognizing the biggest misconception out there. Your score is about consistency, not how much money you earn. You could be pulling in a massive salary, right? But if you constantly max out your cards, your score is going to plummet. On the flip side, you could earn a very modest income. But if you consistently manage your available credit well over time, you can maintain a pristine score. The algorithm is measuring your management habits, not the size of your paycheck. Ultimately, getting a handle on this system is what empowers you to drastically reduce your lifetime borrowing costs. So ask yourself, is your credit score working for you to unlock better rates? Or are you endlessly working to pay the penalty of ignoring it? Take control of your narrative. Thanks for hanging out with us today.